They take trillions of dollars in U.S. taxpayer bailouts at near zero interest. This man is a crook and he needs to go to jail along with his 18 other cronies who need to break up the Federal Reserve. This is anti-job. These men are predators on the American taxpayer money. These guys are not the job creators, they're the job destroyers. We need to bring the money back to the people. We need to start getting money to help people stay in their homes. This man is a crook.
On behalf of Chairman Johnson, I'd like to call the meeting to order and then suspend until the chairman has arrived, and would ask the Capitol Police to restore order. Thank you.
This man is a criminal, and people need to shout out about this man and 18 other cronies that have been stealing near zero interest loans from the people when the small businesses can't get the same loans, when the people are deprived loans to get into their, to keep their houses.
The chairman, the hearing has been called to order. We are suspending until the Sergeant of Arms and the Capitol Police restore order. This is a hearing in which we will ask people to cooperate so that we can conduct a serious inquiry into this matter. Thank you.
Jack, Commanding General, I'd like you to take over, run this place. That's get in.
Where's the chairman? Where's the...
Promised me foreclosure for 3 years, and you sold my house from underneath me. Why don't you face the people that you foreclosed on?
Stop foreclosures now!
Stop foreclosures now! You can give the woman around $2 million, and you can't give her a modification diamond. There's a day coming.
Foreclosures now!
Stop foreclosures now! Stop foreclosures now! Stop foreclosures now! Stop foreclosures now!
come to order. I ask the Capitol Police to please remove anyone in the audience who is interrupting the hearing. Before we proceed, I remind my audience that any interruption of the hearing will not be permitted, and you will be escorted out of the room. We will now proceed. This hearing is part of the Banking Committee's ongoing oversight of the massive trading loss announced by J.P. Morgan Chase and the implications for risk management, bank supervision, and the Wall Street Reform Act. Since the announcement of the loss in early May, this committee has heard from the OCC and the Fed, which are the primary regulators for J.P. Morgan, as well as the FCC, the CFTC, and other relevant officials, to review and learn from these events. Several members of the committee have asked to hear from Mr. Dimon, and after due diligence conducted together by my staff and Ranking Member Shubley's staff, I decided to invite Mr. Dimon. Last week, the regulators informed the committee that there was a breakdown in the risk management involved with these trades, despite the fact that the trades were purportedly designed to reduce the bank's risk. As they continue to look into the matter, officials have assured our committee that the firm's solvency and the stability of our financial system are not in jeopardy at this time. While this is welcome news, questions remain that must be answered if we want our largest bank to better manage their risks to maintain financial stability, as I believe we do. Today marks the 2-month anniversary of Mr. Dimon's Tempest in a Teapot comments, where he downplayed concerns from the initial media reports of the company's chief investment office trades. We later learned, however, was an out-of-control trading strategy with little to no risk controls that cost the company billions of dollars. I have said before, no financial institution is immune from bad judgment. In Mr. Dimon's own words, he later explained, quote, "We made a terrible, egregious mistake. There was almost no excuse for it. We know we were sloppy. We know we were stupid. We know there was bad judgment. In hindsight, we took far too much risk. That strategy we had was badly vetted. It was badly monitored. It should never have happened," unquote. So what went wrong? For a bank renowned for its risk management, where were the risk controls? How can a bank take on far too much risk if the points of trade was to reduce risk in the first place? Or was the goal really to make money? Should any hedge result in billions of dollars of net gains or losses, or should it be focused solely on reducing a bank's risks? As the saying goes, you can't have a cake and eat it too. As for the policy implications, some of my colleagues complained that Wall Street Reform micromanages the operations of a large bank, and the regulators cannot keep up with bank innovation. I disagree with that less supervision and less regulation will magically make the system less risky. While risk cannot be eliminated from our economy, we can and must demand that banks take risk management seriously and maintain strong controls. We must also demand that regulators do their job well. After all, banking is an important but risk-filled business that needs careful scrutiny and oversight so that mismanagement or unsafe and unsound practices do not threaten the stability of our economy. Some also suggest that capital is a silver bullet in financial regulation. While capital does and must play an important role as a backstop, we should not rely only on capital. Any well-capitalized bank can fail and threaten financial stability if it is not well-managed or well-regulated. Our financial system will be safer and stronger with multiple and well-calibrated lines of defense, which Wall Street reform requires in addition to higher capital standards. We need our regulators to finalize these Wall Street reforms, and Congress should fund them with sufficient resources so that they can effectively monitor the financial system. Again, it has been 2 months since he first publicly acknowledged that the trades, so I expect Mr. Diamond to be able to answer tough but fair questions today. A full accounting of these events will help this committee better understand the policy implications for a safer and a stronger financial system going forward. I now recognize Ranking Member Shelby for his opening statement.
Thank you, Mr. Chairman. Today, the committee will hear from the Chief Executive Officer, President, and Chairman of J.P. Morgan Chase, Mr. Jamie Dimon. Mr. Dimon is here today because J.P. Morgan Chase lost more than $2 billion on derivatives trades. Normally, it is not, and I believe it should not be the role of Congress to second-guess decisions by private sector businesses. However, because the federal government guarantees bank deposits, this committee has a responsibility to ensure that banks do not unnecessarily put taxpayers at risk. Congress has, in large part, delegated the responsibility of oversight to our financial regulators. They are supposed to be monitoring the activities of banks like J.P. Morgan Chase to ensure that they operate in a safe and sound manner. As we learned from the most recent financial crisis and this particular incident, regulators do not always meet our expectations. Banks take risks because that's what they do. Usually those risks are beneficial because they enable Americans to buy homes, attend college, and save for retirement. When banks fail to prudently manage those risks, however, serious problems can arise. For example, in the years leading up to the financial crisis, some banks claimed that they could safely provide mortgages to borrowers with no documentation and small down payments. Advances in risk management supposedly enable them to lend to riskier borrowers without threatening the bank's safety and soundness. We now know that this was false. These banks were not applying better risk management techniques. They were simply foregoing time-tested underwriting standards. The result was the failure of some of the nation's largest financial institutions, including Countrywide and Fannie Mae and Freddie Mac. Certainly, there were many bankers that did not make these mistakes, and by most accounts, our witness today was one of them. Yet, as the financial crisis shows, poor risk management, even a single large bank, can have profound consequences. Congress and bank regulators must always watch for risks that could, if improperly managed, threaten the banking system. Accordingly, we should examine the facts and circumstances surrounding J.P. Morgan's $2 billion plus loss. As we do so, I believe that there are two key questions that need to be answered. First, did the losses from these trades threaten the safety and soundness of J.P. Morgan? And second, could it happen again? Last week, the committee heard from the bank regulators that supervise J.P. Morgan. They answered the first question when they told us that the $2 billion plus loss did not threaten the bank's solvency because the bank has strong earnings and sufficient capital. This conclusion shows once again why the single best way to protect taxpayers from bailouts is to ensure that banks are properly capitalized. Strong capital requirements provide a valuable buffer against unexpected losses arising from the inevitable missteps by banks and bank regulators. And although capital should be the first line of defense against taxpayer bailouts, it should not be the only defense. Banks also need to have good risk management. Although J.P. Morgan enjoyed a strong reputation for effective risk management, something obviously went very wrong. Regrettably, the Comptroller of the Currency, the Federal Reserve, the FDIC were unable to tell us what happened last week, despite having more than 100 on-site examiners at J.P. Morgan. Hopefully, Mr. Diamond today can fill in the details. In particular, I hope Mr. Diamond can explain here why these trades were made and why they produced such large losses. I also hope to learn the extent to which Mr. Diamond and other J.P. Morgan senior executives were involved in the decisions that permitted these trades. Mr. Diamond has long been recognized for his effective management of a very successful institution. Yet it appears in this particular case, things perhaps got away from him. Why? Did Mr. Diamond put too much faith in the company's risk models, or did he ignore them? It has been reported that officials at J.P. Morgan may have dismissed warnings that the bank was not instituting appropriate risk management practices. Was Mr. Diamond, if that happened, was he aware of these warnings? If so, did he respond, or did he disregard them? It has also been reported that the office responsible for these trades may have had contradictory mandates. And while the stated goal of the office may have been to reduce risk, employees of the office apparently believed that they were expected to turn these trades into a profit. Bank employees reportedly referred to this profit, quote, as the icing on the cake. What were Mr. Diamond's expectations for this office? Was he incentivizing them to manage risk or to maximize profits? If it was the latter, were the incentives to profit consistent with proper risk management? Moreover, what did the board of directors of J.P. Morgan Chase know about how Mr. Diamond was managing risk? It has been reported that J.P. Morgan's risk committee may not have had the expertise necessary to oversee such a large bank. I hope to learn not only about Mr. Diamond's role in selecting the members of the risk committee, but how the committee oversaw the firm's risk management. Finally, I hope today's hearing can reveal what lessons that Mr. Diamond and J.P. Morgan, others have learned. This hearing will have served a valuable purpose if it helps banks and bank regulators avoid repeating the mistakes of J.P. Morgan. In this regard, I believe it's unfortunate that the committee has not held similar hearings with the heads of other financial institutions. And although the committee is hearing from Mr. Diamond, whose bank lost $2 or more billion of its own money, it has never heard here from testimony from executives of Fannie Mae and Freddie Mac who have lost nearly $200 billion of taxpayers' dollars. Perhaps the committee could turn its attention to the GSE's massive public losses when it completes its review of the relative private losses thus far of J.P. Morgan Chase. Thank you, Mr. Chair.
Thank you, Senator Shelby. This morning's opening statements will be limited to the chairman and the ranking member to allow more time for questions from the committee members. I will note that Senator Warner, as a valuable member of this committee, is absent to attend his daughter's graduation, but he will be submitting a statement and questions for the record. I want to remind my colleagues that the record will be open for the next 7 days for opening statements and any other materials you'd like to submit. Now I will introduce our witness. Mr. Jamie Dimon is the chairman of the board, president, and chief executive officer of J.P. Morgan Chase & Company. Mr. Dimon, your full written statement will be included in the hearing record. Please begin your testimony.
Chairman Johnson, Ranking Member Shelby, and members of the committee, I'm appearing today to discuss recent losses in a portfolio held by J.P. Morgan Chase's Chief Investment Office. These losses have generated considerable attention, and while we're still reviewing the facts, I will explain everything I can to the extent possible. J.P. Morgan's 6 lines of business provide a broad array of financial products and services to individuals, small and large businesses, governments, and not-for-profit institutions. These include deposit accounts, loans, credit cards, mortgages, capital markets advice and fundraising, mutual funds, and other investments. Let me start by explaining what the Chief Investment Office does. Like many banks, we have more deposits than loans. At quarter end, we held approximately $1.1 trillion in deposits and $700 billion in loans. CIO, along with our Treasury unit, invests excess cash in a portfolio that includes treasuries, agencies, mortgage-backed securities, high-quality securities, corporate debt, and other domestic and overseas assets. It also serves as an important vehicle for managing the assets and liabilities of the consolidated entity. In short, the bulk of CIO's responsibility is to manage an approximately $350 billion portfolio in a conservative manner. While the CIO's primary purpose is to invest excess liabilities and manage long-term interest rate and currency exposure, it also maintains a smaller synthetic credit portfolio whose original intent was to protect or hedge the company against a systemic event like the financial crisis or the Eurozone situation. So what happened? In December 2011, as part of a firm-wide effort and in anticipation of new Basel capital requirements, we instructed CIO to reduce risk-weighted assets and associated risk. To achieve this in the synthetic credit portfolio, the CIO could have simply reduced its existing positions. Instead, starting in mid-January, that entailed adding positions that it did believe would offset the existing ones. This strategy, however, ended up creating a portfolio that was larger and ultimately resulted in even more complex and hard to manage risks. This portfolio morphed into something that, rather than protect the firm, created new and potentially larger risks. As a result, we've let a lot of people down, and we are very sorry for it. Now, let me tell you how it went wrong. These are not excuses, these are reasons. We believe now that a series of events led to the difficulties in the synthetic credit portfolio. These are detailed in my written testimony, but I would highlight the following. CIO's strategy for reducing the synthetic credit portfolio was poorly conceived and vetted. In hindsight, the CIO traders did not have the requisite understanding of the new risks they took. The risk limits for the synthetic credit portfolio should have been specific to that portfolio and much more granular, i.e., only allowing lower limits of risk on each specific risk being taken. CIO, particularly the synthetic credit portfolio, should have gotten more scrutiny from both senior management, and I include myself in that, and the firm-wide risk control function. In response to this incident, we've already taken a number of important actions to guard against any recurrence. We've appointed entirely new leadership for CIO. Importantly, our team has made real progress in aggressively analyzing, managing, and reducing our risk going forward. While this does not reduce the losses already incurred and does not preclude future losses, it does reduce the probability and magnitude of potential future losses. We are also conducting an extensive review of this incident, which our Board of Directors is independently overseeing. When we make mistakes, we take them seriously, and we are often our own toughest critic. In the normal course of business, we apply lessons learned to the entire firm. While we can never say we won't make mistakes, in fact, we know we will make mistakes, we do believe that this was an isolated event. We will not make light of these losses, but they should be put into perspective. We will lose some of our shareholders' money, and for that we feel terrible, but no client, customer, or taxpayer money was impacted by this event. Our fortress balance sheet remains intact. As of quarter end, we held $190 billion of equity and well over $30 billion in loan loss reserves. We maintain extremely strong capital ratios, which remain far in excess of regulatory capital standards. As of March 31st, 2012, our Basel I Tier 1 common ratio was 10.4%. Our estimated Basel III Tier 1 common ratio is at 8.2%. Both are among the highest levels in the banking sector. We expect both of these numbers to be higher by the end of the year. All of our lines of business remain profitable and continue to serve consumers and businesses. And while there are still 2 weeks left in our second quarter, we expect our quarter to be solidly profitable. In short, our strong capital position and diversified business model did what they were supposed to do, cushion us against an unexpected loss in one area of our business. While this incident is embarrassing, it should not and will not detract our employees from our main mission to serve clients, consumers, and companies in their communities and communities around the globe. During 2011, J.P. Morgan Chase raised capital and provided credit of over $1.8 trillion for consumer and commercial customers, up 18% from the prior year. We also provided more than $17 billion of credit to U.S. small businesses, up 52% over the prior year. And over the past 3 years, in the face of significant economic headwinds, we made the decision not to retrench, but to step up, as we did with markets in turmoil, when we were the only bank willing to commit to lend billions of dollars to the states of California, New Jersey, and Illinois. All of these activities come with risk. And just as we remain focused on serving our clients, we've also remained focused on managing the risks of our business, particularly given today's considerable global economic and financial volatility. We will learn from this incident, and my conviction is that we will emerge from this moment a stronger, smarter, and better company. I would also like to speak directly for a moment to our 260,000 employees, many of whom are watching this hearing today. I want them all to know how proud I am of J.P. Morgan Chase, the company, and I'm proud of all of what they do every day for their clients and their communities. Thank you, and I'd welcome any questions you might have.
Thank you, Mr. Damon, for your testimony. As we begin questions, I ask the clerk to put 5 minutes on the clock for each member. Mr. Damon, there was clearly a breakdown in risk management at your firm. What did you do, when you made your tempest in a teapot comment? Why were you willing to be so definitive a month before publicly announcing the losses when it appears you did not have a full understanding of the trading strategy?
Let me first say, when I made that statement, I was dead wrong. I'd been on the road, I had called Ina Drew, who ran the CIO. I'd spoken to our risk officers, our CFO. They were looking into it. There were some issues with CIO before April 13th, we announced earnings. I was assured by them, and I have the right to rely on them, that they thought this was an isolated, small issue, and that it wasn't a big problem. They look at things like how bad can it get, they stress it, and under no event it looked like it would be getting nearly as bad as it got after April 13th.
Mr. Damon, there were reports that the CAO had scrapped a risk limit that would have required traders to exit positions if losses exceeded $20 million. Is this true? If yes, did you approve this, and why was the limit removed?
There was no loss limit, I know, of $20 billion.
$20 million.
How much?
$20 million.
Billion.
With an M.
No. Million.
Yeah.
No, I'm not unaware of a $20 million loss limit. CIO had its own limits around credit, risk, and exposure. At one point in March, some of those limits were triggered. The CIO at that point did ask the traders to reduce taking risk, and she started to look very heavily into the area, which is the proper thing to do. Sometimes triggers and limits do get hit, and what should happen afterwards is people focus on it, think about it, and decide what to do about it.
There have been concerns raised about the change made in the CIO's risk model. When were regulators notified? Why was the risk model changed? Did this change mask the true risks of the trading activity?
So what I am aware of is that sometime in 2011, the CIO had asked to update their models, partially to get them updated to be compliant with the new Basel rules. Model reviews are done by an independent model review group. They started the process 6 months earlier, and in January they did in fact put in a new model. I should note that models are changed all the time, always being adjusted to try to be better. Inform yourself of the past and try to make models get better. The models were approved by the model review group, were implemented in January, and did effectively increase the amount of risk this unit was able to take. When on April 13th, we were still unaware that the model might have contributed to the problem. So when we found out later on, we went back to the old model. So the old model was more accurate in hindsight than the new model we thought it was going to be.
Reports suggest there were multiple warnings of weak controls at the CAO that were ignored, and your testimony states that the trading strategy was not reviewed outside CIO. Did you, Mr. Damon, make the decision to exempt the CAO from any review of risk controls outside of the unit? Or why was no one watching?
I think the first error we made was that the CIO unit had done so well for so long that I think there was a little bit of complacency about what was taking place there and maybe overconfidence. It did have its own risk committee. That risk committee was supposed to properly overview and vet all the risks. I think that risk committee itself, while independent, wasn't independent-minded enough and should have challenged more frequently and more rigorously this particular synthetic credit portfolio. I think the second related risk is that the synthetic credit portfolio itself always should have had more scrutiny. It was higher risk, it was mark to market, it should have had more scrutiny and different limits right from the start.
Mr. Damon, did the pay structure for the employees at the CIO incentivize risky behavior that led to the massive trading loss instead of rewarding those who reduced the bank's risks? Were there bonuses for generating profits out of the CIO? Will you seek clawbacks from traders, management, and executives involved in this trading debacle?
So I think, let me just give a big picture about compensation at J.P. Morgan. To start with, we don't, and have not had for 5 or 6 years, special severance packages for executives, change of control, parachutes. There was no one in CIO who was paid on a formula. The management of the CIO portfolio was subordinated to the rest of the company. They were not allowed to do what they want. They couldn't invest very long. They couldn't take too much high-yield exposure, et cetera. They were paid for what they did for the whole company. And when we pay people, everyone, we look at their performance, the unit's performance, the company's performance, and their performance includes recruiting, training, integrity, sharing with senior management, all the things that we need to do to make it a better company. So I don't believe that the compensation made this problem worse, and like I said, none of these folks were paid on formula. Oh, your second question was clawbacks. When the board finishes a review, which I think is the appropriate time to actually make those final decisions, I think it would be inappropriate to make those decisions before you finish your final review, you can expect that we'll take proper corrective action, and I would say it's likely, though this is subject to board, but it's likely it'll be clawbacks.
Senator Shelby.
Thank you, Mr. Chairman.